Welcome to our last lecture. Today we will be covering Chapter 13, titled Saving Investment in the Financial System. We've discussed a little bit of each of these in part, but I want to go over the entirety of the financial system. Next week is Thanksgiving. We have no assignments, but I would use this time to get a head start on your paper. It'll be due the following week. And then after that week, we're going to have the final. So it's going to be coming up pretty fast. Make sure you're ready and prepared. So the financial system consists of institutions that help match one person's savings with another person's investment. Say you want to open a business, how would you go about it? Well, first you're going to come up with an idea. And once you have your idea of what you want your business to be, whether you're inventing something or maybe just selling some particular good or whatnot, you are then going to need to gain capital in order to start producing goods and services. You're going to need a place to do business, office. You're going to need supplies, maybe computers. If you're, doing retail, you might need inventory, and so on. In order to fund this endeavor, you may have previous savings in your bank account that you use. You may ask your relatives for help. You may even find a random guy on the street willing to help you finance your operation or your business for a share of your profits in the future. Or you may ask a bank for a loan. In all these cases, you are using one person's savings to pay for your investment. Remember that savings are determinants of long-run growth. The more savings you have leaves more resources available to develop capital used in the future for economic growth. The financial system is the mechanism between saving, from people saving to developing capital. We have three things to cover in the financial system. What institutions make up the financial system? Second, we are going to look at the relationship between the financial system and key macroeconomic variables. Third and lastly, we will develop a model of supply and demand for funds in the financial market. This model of supply and demand will give us insight into how policies influence the allocation of scarce resources. The financial institutions in the U.S. economy can be broken down into two categories. So we have financial system. We have two categories. The first is going to be financial markets. And the second is financial intermediaries. A financial market is an institution in which a person who wants to save can directly supply funds to a person who wants to borrow or invest. The two most important financial markets in our economy are the stock market. So we have the stock market and the bond market. When a company wants to finance a new factory, it can borrow directly from the public through selling bonds. A bond is a certificate of indebtedness that specifies the obligations of the borrower to the buyer of the bond. A bond buyer is a lender, and a bond is an IOU. The bond states what time the loan will be repaid and at what interest rate. The bond holder can either wait for the bond to mature or can sell the bond at another date. They generally are just like a piece of paper. And it says the issuer of the bond, let's say if it's like Apple, right? Apple will pay the holder of the bond the principal amount, which is the original amount of money you paid to get the bond, plus interest, which is the reward you get from Apple for buying the bond. There are millions of different bonds from private corporations, federal government, state and local governments. All of these have different types of bonds. And all of these use bonds as a method to raise money to finance operations or the construction of capital. These bonds differ through their characteristics. The first one to look at is length. So there's 4 characteristics of a bond. The first is the length of the bond. Or some might say this is the maturity date or date of maturity. The length of a bond or the bond's term matters very much for how much the interest rate you'll be getting and how long it'll take for the bond issuer to pay back the borrower, the buyer of the bond. The lender, not the borrower. Some bonds are short, such as a few months, and others can last up to 30 years or even longer. The British government even has a bond that never matures and just perpetually pays interest, called perpetuity. This isn't to say that they won't pay back the principal amount, but you'll just forever get interest rates. The interest rate depends on the length of the bond, which is why looking at the length is important. Long-term bonds are riskier than short-term bonds because it takes longer for the repayment of the principal. If the holder of the bond needs his money earlier or immediately, then he will have to sell it to someone if the bond is a long-term date of maturity or a long-term bond. If they're really strapped for cash, they'll have to either they may have to sell it, and if they sell it, they might have to do it at a lower price or reduced price than what the bond is worth, or maybe even what they paid for the bond. With a short-term bond, however, he might be able to wait out his urgency for cash, or when he does sell it, it'll be at a less of discount because the person he's selling it to will get the principal back fairly shortly. The second characteristic of a bond to look out for is the credit risk attached to the bond. So 2 will be credit risk. This is the probability that the bond issuer will default on their bond by either not paying the full interest or not paying the principal back. This is if they're going bankrupt or something. If a bond issuer has a higher likelihood of defaulting, then the buyer is going to demand higher interest rates for taking on the additional risk. Let's think about it this way. If the United States was going to offer a bond, what is the probability that the United States defaults on paying back the bond when the bond matures? It's going to be very low because the United States historically has been around for 200 years and they always have money. But if you go to a company or corporation and you look at the financial records and you see that they're not doing too hot, They may issue junk bonds that have really high interest rates, but with a lower probability of paying back the principal or the interest rates. Maybe they pay back some of the principal, maybe they don't pay all of it back. The third characteristic of bonds we want to look at is tax treatment. So tax treatment might be important for how we view bonds. If the tax law treats the interest rates earned on bonds favorably, then that bond might be better than another bond. So on most bonds, the interest accrued is part of a taxable income. Municipal bonds, however, are issued by state and local governments and are not subject to federal income tax, making them better. If you have two bonds with the same interest rate and the same principal, if one's a municipal bond, it's going to be better than the one that's not, because you will not have to pay taxes on the interest rate when the bond matures. This tax advantage from municipal bonds allows government to issue bonds at a lower interest rate than corporations or even the federal government. The fourth important characteristic is if a bond offers inflation protection. You want to look at whether the bond is written in nominal terms or if it's written in real terms. Some bonds index the payments of interest and principal to a measure of inflation, so that when prices rise, the payments rise proportionally. If the bond is written in nominal terms, you won't get that protection from inflation. In 1997, the federal government started issuing Treasury inflation protected securities, or in short, TIPS. These TIPS are protected, these TIPS bonds are protected from inflation, and because they are inflation protected, the government offers a lower interest rate than typical bonds. So that's the first financial market. That covers the bond market. Now we want to look at the stock market. The stock market is another financial market. Instead of issuing bonds to raise funds for capital, a company can instead sell stocks in the company to outsiders. So a share of stock represents ownership in a firm and is therefore a claim to some of the profits that the firm makes. Selling stocks is considered equity finance, and selling bonds is debt finance. So this is debt finance. This is equity finance. You can't see the equity, so I'll pull it back down. So stock markets are equity finance and bond markets are debt finance. Although companies engage in both debt financing and equity financing, they are inherently different and offer different benefits. A bond owner is a creditor, and a stock owner is a part owner of the company. A stockholder benefits from the firm's profit, but a bondholder only gets the stated interest on their bonds. So a bond will only get the principal plus the interest, but if you have a share of a stock and the company does extremely well, you might have a higher return than stock. So you don't really know exactly what you'll get from holding a stock, but you'll know what you'll get from holding a bond. If a company, let's say we have a bond and a stock in the same company. If the company goes under, the bondholders are paid before the stockholders receive anything at all. So if a company calls bankruptcy, they're going to sell all their assets. And first, they'll have to pay whoever owns the bonds before paying anybody who holds stocks. In this way, stocks have a higher risk than bonds, but potentially higher returns. If a firm does well, stocks might pay higher than bonds. Once a firm sells stocks, they generally enter into the stock exchange, where stockholders sell stocks to one another. But when a stock exchanges hands, the firm does not earn any money. So once I buy a stock from Apple and I sell my stock to another individual, Apple no longer gets any money from that trade. Even though when Apple first went public, it was in an effort to, and when they started selling stocks in the first place, it was an effort to raise capital in order to, further expand or develop a new laptop and so on. The most important stock exchanges in the US are the New York Stock Exchange and the NASDAQ, or the National Association of Securities Dealers Automated Quotations. Most of the world's countries have their own stock exchanges. The most important are located in Tokyo, Shanghai, Hong Kong, and London. The prices on stocks are determined by supply and demand. The price is determined by the perception of the corporation's future profitability. If you are optimistic, prices are going to be higher. If you're pessimistic, prices are going to be lower. If I have an Apple stock and I'm considering whether or not to keep it or to sell it, if for some reason I think Apple's going to be doing really well in the future, I want to hold on to that stock. But if I think Apple's going to crash and burn, I want to sell the stock. A stock index is an average of a group of stock prices. So the most famous one is the S&P 500. S&P 500. This indice, or this index, takes the top 500 performing companies in the United States and indexes them together. Takes the average price of them, and we get the S&P 500. Now, the S&P 500, since it takes 500 of the major US companies, and you observe it, if for some reason the price of the index falls, people are pessimistic about the future, and you may be able to glean some sort of forecasting or some perception about what might happen in the future for these companies. Historically, these indices were closely watched as possible indicators of future economic conditions. But in recent years, this has been an increasingly worse indicator. Moving away from financial markets, we want to look at the second category, financial intermediaries. So we're going to cross off financial markets because we did the stock market and we did the bond market. So now we want to look at financial intermediaries. Financial intermediaries are financial institutions that connect savers to investors or borrowers. They typically do this indirectly. You can think of this, or you think of financial intermediaries as the middleman between savers and investors. So if I was going to draw this, right? Savers go to financial intermediaries. This financial intermediary takes it to investors. The investors pay back the financial intermediary through interest. The financial intermediary then pays back the savers through savings rate. So a bank is a financial intermediary, and it's probably the most common one and the biggest type. The primary job of a bank is to take in deposits from people who want to save and then use these deposits to make loans to people who want to borrow. The saver gets the added benefit from the savings rate to protect against inflation, and they also get other benefits such as checks, credit cards, debit cards, and what other services a bank offers. The bank gives out loans to investors or borrowers and charges interest rates. It then also gives the saver the savings rate. The difference between the interest rate on the loan that's being given out to investors and the savings rate that is given back to the depositors is the bank's profit. That's how they pay for all their costs and everybody's salary at a bank. So let's do an example. Let's say there's little me, smiley face. I have dollar bills in my hand, and I go to a bank. I deposit $10,000. So from this arrow, it's 10,000. The bank takes this 10,000 and gives it to a borrower or another firm, an investor, maybe somebody who wants to buy a house or a car. In this particular example, he's going to buy a car that is $10,000. So this is $10,000. The bank charges this man 5% interest on his car. So he pays back $10,500. And then the bank offers me a 2% savings rate. So in a year, after this $10,000 I've given to the bank, I get $10,200. The difference between these two numbers is $300. This is the bank's profit, and that's what they're going to use to pay their salaries. All banks do this, whether it's a credit union or Wells Fargo, Chase, any sort of bank you can think of. Investment banks do this exact same thing, where a credit union is going to be non-profit, in which means they're just going to cover their costs. They're not going to take profit from this. So they'll have lower interest rates when you're getting a car, and they'll try to give higher interest rates to savers. that is how a bank works, and that kind of covers the first financial intermediary. What they're doing is this $10,000, I want to save it and protect my money. And in doing so, a bank is going to ease the ability for people to get money. If they want to buy a car, buy a house, they don't want to go up to a bunch of individuals and ask for money, saying that they'll promise to pay it back, because that'll be very difficult. Instead, they can just go to a bank and ask for that money. The saver doesn't want to go through the hassle of doing a bunch of investment to increase his wealth. Instead, he just wants to put it in a bank and kind of forget about it and hopefully increase his wealth over time. Our next financial intermediary is a mutual fund. So this was banks. And now we are going to look at financial mutual funds. You can just call them mutual funds. But this is the next financial intermediary. A mutual fund is an institution that sells shares of stock to the public and use the proceeds to buy a selection or portfolio of various stocks, bonds, or both stocks and bonds. The advantage of mutual funds is allowing people with small amounts of money to diversify their holdings, so they don't have to take on high risk. Let's say I only have $100 in my account. I could go buy one stock of a company, maybe a couple stocks, but I can't know what's going to happen to those stocks. I might just lose all my money. Instead, I could put it into a mutual fund, and more than likely, my money is going to be safe, or at least safer, and I'll get to still have an interest rate on that money and, increase my wealth. Mutual funds, like the S&P 500, which we discussed, buy all the stocks in a given index. So if we take the S&P 500, if you get a mutual fund for it, you would have a piece of every single company in the S&P 500. Now, there are pros and cons to mutual funds. Some people, because mutual funds are usually done by a company, they have portfolio managers looking over it and try to get the best result they can, or the best stocks and things, so you get the higher return theoretically. However, most economists argue against this because mutual funds that just cover one index, such as the S&P 500, typically outperform mutual funds that are trying to take advantage of active trading. In which they're trying, active trading is when they buy and sell individual stocks trying to get a higher return. So in a mutual fund, let's say I see Apple crashing, I might try to sell Apple because it's going low, and then when Apple comes up, I might try to buy. That would be active trading. I'm trying to take advantage of the stock market situations. However, mutual funds that try to do that typically perform less well than index funds. And this will cover financial mutual funds. We are next going to be talking about saving and investment in the national income accounts. This is kind of like an accounting principle, but for the whole nation. We know that savings and investment are key variables in macroeconomics and play a large part in economic growth. Let's recall the GDP equation that we've talked before about. So if we remember, we had output, or Y, or GDP, real GDP, equal to consumption plus investment plus government purchases plus net exports. This equation is an identity, which means by definition of what these variables are, this equation must be true. To simplify our equation, we are going to consider a closed economy. This just means we are not going to engage in international trade, meaning we can drop net exports from our equation. We can get rid of this. This is just to simplify it. We are left with output is equal to consumption plus investment plus government purchases. We can rearrange this equation to get I by itself. So if I subtract C over and I subtract G over, I'm going to have Y is minus consumption minus government spending is equal to investment. Let's consider the left side of this equation. Y minus C minus G. Y is our total income or total expenditure, whatever you want to consider, but it represents the income of our national economy. C is the amount that people like you and I consume, and G is the amount that the government consumes. So if you have our income minus our spending, what would this mean? This is savings, right? Income minus spending, savings. Which is equal to investment. So by accounting principles and our identity, savings should be equal to investment. We can also include taxes into this. If we want to include taxes, it's just going to be a little bit different. We're just going to add some t's. So t will be taxes. Now t represents a negative on consumption. Right? It's going to decrease consumption. Or it'll decrease the income of people, which will generally increase consumption. But T is also the revenue for government purchases. So if I wanted to write what savings was equal to, I could say savings is equal to our income, which is going to be Y, minus the taxes, minus consumption, plus our tax revenue minus government purchases. This is private savings. And this is public savings. This is how much the government saves. This is how much we as a collective or as an economy saves. Let's consider what happens with T and G. If T is greater than G, that means our taxes are greater than our government spending. That means we are going to have a budget surplus. Means the government is saving more than it's spending, or it's earning more than it's spending. So it must be saving some, which would make this whole side positive, which means our savings would be greater, right? If G, however, is greater than T, that means our spending is greater than our revenue. The government spending is greater than our taxes, which is their revenue. That's going to be a budget deficit. And if they're equal, G is equal to T, we typically call that budget balanced or balanced budget. So if G is greater than T, that means this is negative, which means our savings is lower. If T is greater than G, this is positive, meaning our savings is higher. If G is equal to T, this is 0, and our savings would be equal to our private savings. You may think that when you are putting your money into stocks, you are investing your money. And in common day language, that's perfectly fine. But economists have slightly different terms for savings investment than you might be used to. To macroeconomists, investment refers to the purchases of new capital such as equipment or buildings. This also includes houses. If I go to a bank, I take out a loan and I buy a house or I build a house, that is considered an investment. If a firm wants to build more buildings or more factories, that is considered an investment. So economists don't believe that buying stocks and bonds are investments. In fact, we think that's the opposite. We think that when you buy stocks and bonds, you are actually saving, not investing. This moves us to the market for loanable funds. Let's assume the economy has one market for all the savings and all investment purposes. All savers go to this market to deposit their savings, and all borrowers go to this market to take out their loans. Loanable funds refers to all the income that people have chosen to save and lend. We are only going to have one interest rate in this market. The return on savings and the cost of investing are going to be the same interest rate. This may not seem entirely realistic, but for our purposes, it'll do. We can now talk about supply and demand for loanable funds. Savings is the source of supply for loanable funds. So our supply in this supply and demand graph is going to be our savings. Our demand for loanable funds is going to be our investors. So I'll put at the very top, loanable funds market. On the y-axis, we are going to have the price, which will be the interest rate. On the x-axis, we're going to have loanable funds. Our supply of savings, if the interest rate increases when savings, would you want to save more or less? You're going to want to save more. If I know I can get a higher interest rate when saving, I'm going to deposit more of my paycheck each month into my bank account to get a higher savings rate. So as the interest rate rises, the supply rises, the loanable funds amount, which means it's a positive relationship. So we can draw our supply here. And we can also consider this our savings. As the interest rate goes down, investors are going to want to get more money so that they can invest in more projects, because it's relatively cheaper to do so. So as interest rates go up, the opposite's true. They're going to want to invest less. So there's an inverse relationship. This is our demand. Or investment. So this seems like a typical supply and demand graph. And it pretty much is. If the interest rate is below the equilibrium, because where they meet is the equilibrium at this point, if the interest rate goes across and is below this point, we can see what will happen. So at this point, our supply is here, demand is here. Draw a line, and we can see that the demand for loanable funds is much greater than the supply. So if interest rates are less than equilibrium, then our demand is going to be greater than supply. If our demand is greater than supply, that's going to be a shortage. In a shortage, lenders are going to be encouraged to raise the interest rate they charge, because the people here on the demand, if we go straight up, so this is the quantity that is being supplied in demand. At this point, this supplier will want to pay, right, because it's higher than the interest rate they're getting. This demander will want to agree to that payment because their demand is higher than the supply, and then we'll just push this point back to equilibrium. And it won't go past it, right? Because if we try to go past this point, the person who is going to get a loan thinks the interest rate's too high. But at this point, the lender can offer a higher interest rate, and the borrower will think it's a good deal. This person here thinks it's a good deal to buy it here. So we'll keep pushing it back to equilibrium. If the equilibrium is above, if the interest rate is above equilibrium and we are above the point, let's say we're up here, supply is going to be here, demand is going to be here, and if this is the case, unfortunately I didn't draw my graph perfectly, then supply is going to be greater than demand. So interest rates greater than equilibrium, supply is greater than demand, and this is a surplus. As lenders compete for scarce borrowers, interest rates are going to be driven back down. And why is that? So this is the amount of money in the market. These people think the prices are too high, right? Because they're up here. Well, when they push it down, they can attract more borrowers, and in which case they would make more money. And that's going to push it back to equilibrium. This is the same supply and demand you have seen many times before. However, with this specific model, we can analyze how policy affects savings and investment. So first, we want to know, if we want to analyze it, there's steps to take. First, we want to determine if the policy is going to shift one of the curves, and if it does shift one of the curves, which one? Next, we want to know the direction of the shift, if it's shifting left or is it shifting right. Third, we are going to use the supply and demand to see how the equilibrium changes from the old one to the new one. Let's go over some policies considering savings. Generally, economists and policy makers want to increase savings. The logic is the more savings there are, the more investment there will be, because savings is equal to investment. And in the future, our standard of living will increase. So the first policy we want to look at is reform the tax code to encourage savings. First, let's go step by step. Which curve is this policy going to affect? Is it going to affect supply or demand? Well, because it's a tax code to give benefit to people who saves, it's going to affect the supply curve. So we know which curve it's going to affect. The next is to determine which direction it's going to shift. Because in this specific example, we are going to give tax breaks to people who save more, then the supply or savings is going to look good at all points. So supply is going to shift to the right. We can do a quick graph. So in this case, saving incentives. So if there's a policy that improves saving incentives, this is going to be the case. We have our interest rates here. Multiple funds. Our savings is here. Our investing is here. Our shift, we said, was going to be to the right. So it's going to be like so. This will be our S2. And this will be our S1. And this is D. If savings increases to our right, we can now examine the new equilibria and compare it to the old. So at the old, we had this interest rate, and we had this quantity. At the new, we have this interest rate and this quantity. This will be R2 and R1. From here on, I'm just going to put interest rates as R and loanable funds as Q. So comparing the new equilibrium to the old one, we have lower interest rates and a higher amount of loanable funds. This means our investing is higher. If demand is our investment, that means the quantity that's being invested is higher, and at lower interest rates. Now, let's look at an investment credit, tax credit. So this is going to be focusing on demand. So we can draw our supply and demand again for our loanable funds market. We have R here for our interest rates, and we have Q here, which is going to be our quantity. We have supply, and we have demand. S, D. So this is going to be a similar idea. We're going to give a tax advantage to firms or individuals engaging in investment. This is going to make investing more attractive. So the demand is going to shift in which direction? Our first step is, well, let's take it step by step. Our first step is decide which curve is shifting. Because it's an investment tax credit and we are trying to encourage investing, we know it's going to shift our demand, not our supply, because demand is our investment. If our demand is shifting and it's becoming more attractive because we want to encourage investing, that's going to shift our demand to the right. So if we draw that, we're going to have our D2, and we're going to have a new equilibrium from here, and we can compare the old to the new. So this is our R1 or our R, and this is our quantity. This will be our R2. This is going to be our Q2. So our interest rates are higher and our quantity is higher. So here, what was the case? Our R decreased and our Q increased. And then here, our R increased and our Q decreased. And of course, the opposite is true for all of these. If we enact a policy that decreases demand and we go here, our interest rates are going to decrease and our quantity is, sorry, this should be increase. I don't know why I drew a negative. This should be increase. So if the opposite occurs and demand shifts to the left, our interest rates are going to decrease and our quantity is going to decrease. If we have adverse saving policy and we decrease savings and we push this to the left, we're going to have increased interest rates and decreased quantity of loanable funds. Let's look at what happens when the government runs a budget deficit. So let's pull up this piece of paper. I said a budget deficit was when government spending was greater than the taxes or the government revenue. If the government runs a budget deficit, this means their spending is greater than investment, which means savings is going down, right? So our savings is going down. If savings is going down, we're going to shift the curve to the left. and we can draw that. And if it shifts to the left, we already know what's going to happen. Oh, this one got ink on it from the previous one. So this will be for a budget deficit. R will be interest rates. Q is quantity. We have our demand and our supply. So budget deficit, again, is when taxes are less than government purchases, meaning we're spending more than the government is receiving, which means our savings is negative, so it's going to be a negative savings. If our supply represents our savings rate, that means our supply line is going to shift to the left. And as predicted, we have a higher interest rate and a lower quantity than our previous equilibrium. So this was Q, this was R, and then this was R2 and Q2. So in a budget deficit, T is less than G, we have negative savings rate, and also our R increased and our Q decreased. A budget surplus is going to have the opposite effect. It's going to be exactly the same as a saving incentive. Our S is going to increase, our R is going to go down, our Q is going to go up. Over the years, the US government debt has fluctuated. We have the US government debt from 1791 all the way to 2012. So if we start at the beginning, in 1791, it was around 40%, and this was because of the Revolutionary War. This government started in a lot of debt to the French and other interest groups that had a stake in the Revolutionary War. Over time, we started paying it off, and we ran, it slightly increased. In 1812, there was the War of 1812. So it makes sense there was another little bump in our debt. But overall, we kept running a budget surplus and paid back all this debt that we owed. And even in 1835 or so, our debt was zero. And then we hit the Civil War in the 1860s. And we accrued a lot of debt. Almost as much as the Revolutionary War, but not quite as much. And again, after the war ended, we started paying it back, and we continued with budget surpluses, so our debt decreased. Around 1914, 1917 is when America gets involved in the war. 1914 is when the war starts, and our debt increases drastically again. And then we start paying it back, and then all of a sudden around 1930, it shoots up quite a bit. Why is that? Well, in the 1930s, we know the Great Depression occurred, and when FDR took office, he was having his whole New Deal program, and he started spending a lot of money. And in doing so, he accrued a lot of debt through bonds or printing money, however he wanted to do it. At the time, obviously the president doesn't have say in what the Fed does, but he could still sell bonds or raise money other ways. So, our debt increased, and then World War II happened, and our debt rose to almost 100, maybe even above 100% of our GDP. What does that mean when our debt's above 100% of our GDP? Well, GDP is measured yearly, so that means if you took all goods and services made in that year, that would pay off how much the government spent in just that one period, which is a lot. That's a significant amount, right? That means for a whole year, if you took every piece of income from buying food, making gas, making cars, making every single thing that America does, and you gave it to the government, they would be at a balance of zero. So they spent a lot of money during this time. But after, we enjoyed a nice period where we were paying back this huge amount of debt. And our GDP was significantly higher than our debt. But then around the 80s, it starts to go up again. What happened at this time? Well, Ronald Reagan took office. And we'll go over that a little bit more later. In 2011 or 12, the financial crisis occurred. I mean, it happened in 2008, 2009, but our debt has been rising since the financial crisis. So what happened in the 80s? Well, Ronald Reagan took office during this time, and he wanted to cut taxes. Even though he wanted to cut taxes, in order to do so, in order to keep us out of debt, increasing this debt ratio, he would have to cut government spending. And doing that is very difficult. Ronald promised tax cuts when he delivered on his tax cuts. However, he did not cut back on government spending. In fact, he raised government spending, running a large deficit. So if we look back at our page here, right? So we had taxes and we had government spending. He decreased. Here, let's rewrite it. And I'll take away the book. So we have taxes, which is government revenue. And then we have government purchases, which is government spending. So he increased this, decreased taxes, and what would that cause? That makes T less than G. If T is less than G, that's a budget deficit, which means we went into debt. Sorry, let me just rewrite this. Now, it's not that Ronald Reagan wanted to put us in so much debt, and it's not any president since has wanted to do that. No president wants to put us into debt. However, cutting government spending is extremely difficult for a politician. Bill Clinton in the 90s worked on reducing the deficit, and quickly after, George W. Bush enacted similar tax cuts to Ronald and ran a budget deficit again. And he increased spending because of the war on terrorism and the war in Iraq and stuff like that. Whether the deficit is ran by increasing government spending or reduces taxes, the result's the same. So you can leave one the same or you can just change one, or in the case of Ronald Reagan, you did both. In all cases, it's going to decrease our savings rate, it's going to reduce the amount of quantity invested, and it's going to increase the interest rates. Typically, that's not a good thing. If we're decreasing our investment, that means our standard of living in the future is going to be less than it were if we didn't decrease our savings rate. And what I meant by Ronald and George W. Bush and a lot of people having difficulty cutting budget restrictions or cutting government programs, let's talk about this a little bit. Milton Friedman, Nobel-winning economist in 1976, warned about increasing in government spending. His quote, he said that nothing is so permanent as a temporary government program. The problem that Milton Friedman is discussing is the exact issue that Ronald Reagan and George W. Bush and almost any president that runs a budget deficit runs into. When they're trying to balance the budget, they have to either increase taxes or cut back on government spending to get us into a budget surplus or to get us to a balanced budget. Now, if you're reducing government spending, this usually means cutting back on certain programs or canceling them. In either case, this is going to cause unemployment. If you fire a bunch of people, they're going to be out of work, and this is going to make the politician look bad. So they may not want to cut on certain agencies like the FBI or military spending and things like this. So they might try to look for different places to cut back on. And maybe they choose to cut back on social welfare programs, such as unemployment insurance and things of these nature. But by doing so, this is going to make them look really bad to the public because they're cutting programs that help people. If you cut like food stamps, for example, everybody on food stamps is going to be really upset. Some people who aren't food stamps are going to be like, hey, why are you cutting their food stamps? They need that for food. So in either situation, the politician looks really bad. It creates a scenario in which reducing government spending is political suicide. So no politician wants to do it. And even if they're going to go out of term, they don't want to be looked back on as somebody who was hurting the poor or, laying off workers. In either case, it doesn't look great. Now, they can also raise taxes, but nobody likes taxes. Everybody would rather have the government provide services without having to pay taxes. When you get your paycheck at the end of the month, seeing them take out so much money, it's not a great feeling. So cutting taxes is generally quite favorable. That gets into the situation where we are decreasing taxes and increasing government spending, or at least keeping government spending the same, which is going to cause budget deficits. Now, we also learned that during a recession, one method to improve the conditions was for government to increase spending or government purchases and stimulate demand, pushing it back to its equilibrium or to where it was. This was what Keynes taught. This was the lesson he believed in. He assumed that when the economy was back on track, that the government would run a budget surplus and paying off the debt accrued during the recession. So he thought, recession hits, government increases spending, they take on some debt, but it doesn't matter. The government spends money, gets the demand back to where it's supposed to be. When it's in a good spot, government then stops the spending and gets a budget surplus and pays back the debt. So then the government ends up back at zero and the economy is stable. Sounds pretty good. However, if you think back to what Milton Friedman said, he argued against this since he believed government would not cut back. because politicians were worried about cutting back. It's, they don't want to lose their job or they don't want to be remembered poorly. So Milton Friedman said, hey, I want to increase AD or aggregate demand through monetary policy instead of fiscal policy. And because the Fed is an independent of the executive branch, they don't have to worry about, getting reelected and things like that. It would not be worried about influence of the money supply even if it looks unfavorable. I mean, there's still the issue of maybe being looked back on in history as not very good, but that might be less of a worry for them. Well, this concludes our last lecture. We discussed the types of financial institutions, including financial markets, both the bond market and the stock market. We also covered financial intermediaries, like banks and mutual funds. We went over the relationship between the financial system and some key economic variables, mainly savings and investment. This is how banks interact with savings. This is how the stock market works with savings and investment. And that's how we got our S equal to I. We also looked at how various government policies affect interest rates and society's allocation of scarce resources, while also looking at the United States deficit and history of debt. I just want to say you guys have been wonderful. Thank you for being very patient with me. This was my first time teaching, and doing online has been pretty challenging, especially for me. But we made it through. Again, thank you.